What's up, financial freedom seekers? Today, we are diving into a story that shook the market, especially here in Malaysia. We are talking about CCH Holdings, ticker CCHH, a company that runs a popular hotpot chain, chicken claypot house with roots right here in Penang. But their journey on the NASDAQ, well, it was less a smooth simmer and more an explosive boiling pot that then crashed and burned. And there are some massive lessons here for every single investor watching this. If you blink, you might have missed it. CCH Holdings went public on the NASDAQ in October this year at $4 a share. Within weeks, it was screaming upwards, hitting highs of over $15. People were thinking, is this the next big thing? Then, almost overnight, bam! The stock plunged over 80% in a single day, wiping out fortune, crushing dreams, and today it's a fraction of that peak. So, what the heck happened? And more importantly, how can you avoid falling into similar trap? Let's break it down. First, the CCHH breakdown, the anatomy of a crash. To understand the crash, you need to recognize how value was totally divorced from price. It comes down to two keywords, thin float and speculative valuation. Keyword, the paper thin float. Imagine the total number of shares is a giant swimming pool. For CCH Holdings, only about 6.5% to 7.4% of those shares were actually available for the public to trade. That small fraction is your float. A thin float makes the stock incredibly volatile. Even a small number of retail buyers can push the price up artificially, creating a massive price bubble. But when sentiment reverses and those initial buyers start to cash out, the lack of depth in the market guarantees a cliff-like decline. It is structural instability. Keyword 2, insane valuation. At its peak, CCHH, a regional hotpot restaurant chain that started in Georgetown, Penang, was valued at a PE ratio of over 80 times earnings. Let's apply some computational thinking here. A stable local company like this should trade maybe at around 10 times to 15 times PE. A global tech giant like Google trades around 25 to 30 PE. When you pay 80 times earnings for a chicken hotpot chain, you are not investing. You are gambling on the griddle fool theory. That kind of valuation tells you the narrative has broken entirely from the underlying value of the company's industrial properties or its core F&B business. You are paying supercar prices for an ayam penyet stall. Second, the lesson, how to avoid the deep value trap. This is where you switch your focus from speculation to the discipline of deep value investing. Here are the 3 rules to protect your portfolio going forward. Rule number 1, know the difference between price and value. The CCHH case is a textbook example of price abandoning value. Always calculate your key variables such as revenue, PE, cash flow, and establish an intrinsic value before you even look at the stock chart. If the market price is 5 times your calculated value, it doesn't mean you are wrong. It means the market is driven by hype. Avoid the hype. Rule number 2, insist on liquidity and structural health. If a stock has an ultra thin float, it is inherently risky. Look for companies with broad ownership and high trading volume to ensure that when you want to sell, there are plenty of buyers at a fair price. Don't mistake volatility for opportunity. True investment opportunity is found in stability and a sound structure. Rule number 3, filter out the FOMO noise. When the stock soars 200% in a week, the fear of missing out or FOMO is toxic. Remember, by the time a stock becomes headlines news for its sudden surge, the easy money has already been made. As a critical coach, I'm here to push you to do better and think deeper. Focus on finding undervalued assets, not chasing overvalued ones. That is the essence of building generational wealth. If you are serious about avoiding these traps and focusing on what Warren Buffett calls value over growth, the exact opposite of the CCHH menu, then I have the tools for you. I have put my computational thinking and expertise in value investing into 2 resources designed to help you analyze company like an authority. For the theory and framework, join the Deep Value newsletter. It is where we analyze company fundamentals, challenge assumptions, and uncover what a business is truly worth. For actionable, hyper-personalized ideas, get access to deep value investing ideas. This is where we put rigorous analysis to work and identify potential investment opportunities based on genuine undervaluation, not speculative hot air. The link for both is right in the description below. Stop chasing the market and start finding the diamonds in the rough. If you found this helpful, smash that like button, subscribe for more insights, and let me know in the comment below. Have you ever been caught in similar trap? Let's keep learning together. Thanks for watching, and remember, invest smart, not just hard. Bye, and I shall see you again in my next video.